What's happening right now in banking? Well, hey everyone, it's John Chapman, certified financial planner with WorthPoint Wealth Management, here with a quick market commentary video for those that are worried about investing and depositor risk at banks right now and wondering what they should be doing with their money. Let's start with a backdrop. Silicon Valley Bank was in a poor position leading up to their demise. As we can see in this chart on the bottom right here, JP Morgan analyzed many of the large banks in the country, and they showed that Silicon Valley Bank was in one of the worst capital positions. They had large loans against the amount of deposits they had, and that really was a recipe for disaster. On top of that, depositors were spooked and pulled $42 billion in just one day. And that is a definition of a bank run. So in the end, the collapse was due to poor corporate management, a concentrated customer base, also the fact that we had an inverted yield curve, which we'll talk about in a sec. And so to summarize, Silicon Valley Bank had more in expenses than it had in interest income coming in from their loans. And that's just not possible to run a bank that way. So looking at some perspective, over the past 1 month, the S&P 500 is down about 4.5%, this chart in blue. Vanguard Financial ETF tracks a lot of the large financial stocks. It's being pulled down about 14% due to some fear and contagion about what's going to happen in the banking world. You can see this light blue shows Silicon Valley Bank stock, how it dropped dramatically in the period of just a few days, which is an important side reminder of why we shouldn't be concentrated in investing in just individual stocks and why we want to remain more diversified with our investments. But I'll get to that a little bit later too. And finally, since Credit Suisse has been in the news, here shows their stock performance over the past 1 month. Let's talk very briefly about Credit Suisse. And it's important to note the issues there, while they might have some overlap to Silicon Valley Bank, there are still other issues. At this article with Reuters shows that the bank has battled a lot of scandals over the past 2 years, with issues with their customers, issues with their employees. So here's an important point. If folks are wondering if Credit Suisse and Silicon Valley Bank are canaries in the coal mines of banking and worried that the banking system is going to pull us all down, while that could be a possibility, these events seem like they're issues tied to the bank. And it may not be a structural issue for the rest of the banks in the country. And so let's talk a little bit about the difference between being an investor and a depositor. An investor is someone that buys a stock in a company. You're hoping the price goes up if that company does well, but you also bear the risk of the stock going down if the company does poorly. Now that's one type of risk. Something different is the risk of being a depositor at a bank. So for those of you that are worried about your bank accounts, your checkings and savings, let's talk a little bit about FDIC insurance. If a bank goes bankrupt, you're covered up to $250,000 per account registration and per Social Security number. So just a quick example, let's say Mr. and Mrs. Investor at XYZ Bank. Mr. has $250,000 in a personal checking. Okay, that's covered. Mrs. also has $250,000 in her checking. Well, that's a different registration, so that's covered. And let's also pretend they have a joint account. That's a different registration. They've got coverage for each of their socials of $500,000 combined. So here's $1 million of coverage against a XYZ bank going bankrupt. If this family has more than $1 million, then yes, they're as depositors, they're at risk and they need to understand the risk exposure there and maybe look at using different banks. But as you could probably understand, very few Americans have more than $1 million in general, just in cash, and need to worry about this. So my comment to depositors is that you're probably not exposed to that much risk. But of course, you need to do your own due diligence. Let's shift gears and just do a quick backdrop on the economy. and understand how we got to this place and how we got here in the first place. You can see over the past 50 years, inflation has been high and then low and everywhere in between. Inflation has been really low over the past 5 to 10 years. But after COVID and the supply chain restrictions, inflation just went sky high. And so in order to pull inflation back to planet Earth, the Federal Reserve jumped in to raise interest rates. And that's a normal function, normal tool that they will use in order to try to slow the economy and slow the increase in prices. You can see here, interest rates had been incredibly low after 2008. And some may criticize the Fed for this. They started to raise rates in 2018. Then COVID happened. They lowered rates. They waited a year and a half. And then all of a sudden, inflation was crazy. So they raised interest rates 8 times over the past 12 months. And now we're here. We're at a high interest rate environment. And again, the Fed is hoping to slow the economy down. And we might be at a turning point. You can see in this graph, you can understand economics by thinking about the 4 different seasons to our calendar, where we've got winter, spring, summer, and fall. Well, translating that to the economy, we've got a recession, maybe let's call that winter. We've got early cycle, spring, mid cycle of summer, and late cycle of fall. So raising interest rates has pushed us near a recession, not quite there yet, again, with the hope that maybe there will be some layoffs, maybe companies won't raise prices, and that way inflation can come back down. And I'm sure while you love Economics 101, let's get really tangible and wrap up this video with some action items. And first, let's look at a case study for those who are in their mid-career. Let's say they're in their 30s, 40s, or 50s. Here is a balance sheet of this investor. This investor has $400,000 in their 401k. They've got $150,000 in an investment account, $40,000 in cash. Combined, that's $591,000. And as a percentage, they've got 80% of that in stocks, about 15% in bonds, and about 5% in cash. So it's important to take a period right now where we've got market instability as investors and think, what's my risk exposure as an investor? And let's pretend that the stock market, broadly speaking, goes down, let's say 10%. Then $468,000 that's in the stock market, if it went down 10%, that'd be a loss of about $46,000. If the stock market went up 10%, then that would be a gain of about $46,000. So you can use a chart like this to say, am I comfortable with these fluctuations being mid-career, knowing that I've got a longer time horizon, knowing that I'm adding money into my investments? And that's a conversation you should be having with you and your family and your financial advisor. Let's build on this and think about taking a long-term view. So this same investor, mid-career, has a combined $591,000 of investable assets. Let's just project over the next 10 years if they can have an average 7% rate of return. This isn't a guarantee, I'm just using an example here. And let's pretend they add $1,000 into their investments and retirement accounts. Well, over the next 10 years, that'd be $120,000 of contributions and $622,000 of compound growth coming from their investments, leaving this investor with an ending balance in 10 years from now of $1.3 million. Now, this is a fairly exciting outcome given even in the midst of a rocky market environment. So my comment to those that are mid-career is to just stay focused on their long-term goals, stay diversified, continue to contribute, and let the magic of compounding unfold. Let's take one more case study example for somebody that's maybe in their late 50s or 60s or 70s. They're near retirement, they're in retirement. Let's pretend they've got $1.5 million in retirement accounts. They've got $500,000 in brokerage accounts and $110,000 in cash. So this investor that has $2 million At a moment like this, where the stock market is rocky and folks are worried about banks, here's another great example to look at their balance sheet and understand, am I comfortable with my risk exposure? This person has $857,000 of their $2 million in stocks. So a 10% drop would be $85,000 down. A 10% increase would be $85,000 up. And of course, there is risk in bonds as well. But it's important to understand this is a different way to craft your financial portfolio and think strategically, how does this portfolio help me get to where I want to go? All right, so in closing, I want to encourage you, if you're worried about being an investor at a bank, you have to understand your financial goals, understand your time horizon. If you're worried about being a depositor at a bank, understand the FDIC insurance limits. And with all of this, make sure to plan for any upcoming life events. And if you do that, you're going to be on track with your financial plan.